Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. So today I want to talk about the earnings seasons overall. I'm quite excited to talk about this because so much has happened in the last several weeks. There was a few topics that I feel that are particularly interesting. Hi Tom, that I felt that were particularly interesting that I wanted to highlight. Okay, so it's been a really difficult earnings season, and I mean, like I've seen all kinds of things just dramatically sell off. Obviously, the noteworthy ones: Snap, Peloton, Upstart. Those are, I think, some of the things that I noticed that I was not expecting to see. Need some kind of nuance to that, to be honest, but that's one of the things I wanted to highlight. So there's a few things that I wanted to highlight from that I'm going to talk about. So going forward, please write to me a couple of questions that you'd like me to address, because someone, Miru, has been very helpful to me. He's kind of tried to guide me through and say, okay, get people to write in their questions before the show, because then you can give fuller answers. And yeah, I really want to help out people, and I really want to, people have been really, really kind to me, and they've been just helping me think about how the podcast should develop, and I just want to give back to the investment community. So please write in some questions beforehand. By all means, if you feel like you want to, do write in now, but if you want me to kind of spend some time thinking about the answer before I give it out to you, make sure to write to me beforehand, and I'll try to address it. So here are a few things that I wanted to highlight. Okay, so I want to particularly talk about stop losses, because this is something that's very near to my heart. I spent a lot of time thinking about this. So many people have told me, oh Michael, how can you invest without a stop loss? And I mean, how can you invest with a stop loss? Because you've seen the volatility in some of these companies. I've been talking about for many months now. Digital Turbine, for instance. Digital Turbine has just been, look at the volatility of this company. If you'd had a 10 or 15% or even 20% stop loss, you'd have been just stopped out of this company. And numerous times in the last 12 months would have been stopped out. But you look back to where the company has gone in the last 12 months, they just continue to grow. So this is just one example, and I can highlight so many examples to you that you just go crazy. Go through, think about the company, try to understand where the company is going to be over the next 2 or 3 years. That's the reason why you either stay with the business or don't be staying with the business. Don't let the share price go up or down, decide for you, okay? So that's one of the things I want to highlight. Please don't get a stop loss, because the stop loss is just, it makes the brokers rich. It doesn't make you rich, okay? You are an investor in a company, and your return is proportional to how long you've been invested in that company. It's not trying to be smart and time the market perfectly. Another thing that I want to highlight, so many people have been telling me, I'm keeping money on the side because there's a crash coming around the corner. I've heard from so-and-so that's very, very intelligent, blah, 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 and there's a crash coming. Okay, there's a Peter Lynch quote that helps you think about this. More money has been lost in anticipation of a correction than in the correction itself, okay? So people get so anxious, and I say to people, okay, in 2019, how many people could have predicted that in 2020 the stock market would crash by more than 30% in a few weeks? Very, very few people. And of those people that could have predicted that, how many would have predicted that 2020 would actually end up higher than it did in 2019? Even fewer. So it's absolutely berserk to think that anyone can predict with any certainty. And even if you could make a guess of where things are going to go in the next several months, I mean, it's unlikely that you could repeat that. So that's just something that I wanted to highlight about that, okay? One more thing that I wanted to highlight. Please don't think about using options. I know options are really, really popular because people think that this is not personal to anyone, but don't use options, because options is a leveraged instrument, okay? And the likelihood is, so you've seen many of these facts, but approximately 90% of all options expire worthless, okay? So it's like going to a casino and you have a 90% chance of losing your money. I mean, like, who takes that bet? That's not a worthwhile bet to take. When you go to a casino and people lose all their money when there's like 55% chance of losing the money. And so just like stop losses, again, help make the broker rich, don't help you as an investor compound your wealth over time. I talk about this so many times. In investing, it's not about the next 12 months, it's about the next 20 years, okay? The 20-year game that I call it. You want to try as close as possible, get to that 15% return over time, okay? You don't need to do anything more than that. You don't need to leverage. People talk like, oh, I like to leverage, I do these kind of options like this. You don't need any of that intelligent stuff. Well, it's not intelligent, but anyway, that's for another day. Just try as much as possible to think as the owner of the business. I have a portfolio of businesses and I feel that I'm the owner of those businesses. I go to sleep and I think, okay, I own XYZ business, that's my business, I'm a proud owner of that business. And once you think like that, then it helps you understand that the volatility is just something that really kind of, it's just part of the business, it's part of the stock market. If there wasn't this volatility, then the market wouldn't be working at all, because the market is an auction, right? You're saying that XYZ company is worth this amount, I'm saying that it's worth that amount, and it's kind of like that's what the market is for, right? It needs to go up and down. If it never came down, then you'd have even worse sell-offs at some point, okay? I don't know anything about cryptocurrency. I have no interest in touching cryptocurrency. I'm sorry, I know that puts some people off. How did Buffett say it in the annual meeting? He said he's much more witty than me. Basically, for me to pass the comments on crypto, it would just please the 4 people in the room, whereas the other majority of the people that are very much interested in crypto, I will just annoy. But ultimately, I don't want to be invested in crypto. I have no idea about crypto. It probably is something truly cool, but I have no idea how to price that. So just one more thing before I kind of get started. So someone asked me to explain what happened with PayPal and how PayPal compares with Square, okay? So PayPal was expecting to be growing into Q4 and onwards at approximately 20%, more or less, okay? Their ability to guide for Q4 misses the estimates by approximately 400 million. It wasn't a lot, it was just a margin, it was just a little bit, but it was going to miss slightly. This was because they're moving away, eBay is moving away from PayPal, and they felt that they could mitigate a certain portion of that revenue loss towards eBay by growing the underlying business, okay? Now, what's happened is that the part of the business that's growing without eBay is now expected to grow at approximately in the ballpark of 18% into next year. And this has substantial implications because everyone that has been closely, like big money, that's been closely following PayPal, this narrative had been that into 2022, when they come around to lap the easier periods from this year, they'll be growing at approximately 22 to 25%, okay? They were saying very conservatively, they've been saying all the time that going into, once we lap that period, going into 2022, we're going to grow up approximately 25%. If you know this management team, they're very, very conservative, so when they put out something, people kind of trust it, okay? The PayPal mafia, people call it. People get very excited about saying that. Anyway, but ultimately, once the business changes its growth rate, it dramatically changes the multiple. Now, I just want to double click that slightly, because people say to me, Michael, you always talk about the multiple. What does the multiple mean? The multiple is the price to sales, or the price to earnings, or the price to cash flows. It doesn't really matter. It's just they're all proportional to each other. So as the price to sales expands, the price to cash flow also expands, and conversely, as the price to sales contracts, the price to cash flow also contracts. So the multiple is the perception that people are willing to pay for the company, because everything in the short term is all about perception. So when the business is doing great things, growing at a rapid rate, and investors have a lot of confidence on the visibility of the business and its ability to grow and expand margins and take market share, people pay a higher premium. And over a very long period of time, as the business naturally starts to slow down, the multiple will compress, okay? But it doesn't compress kind of slowly. It kind of, it compresses quite dramatically, because there's a change in people's confidence, there's a change in people's perception of the underlying business. So in the case of PayPal specifically, if the company is expected now to be growing at approximately 18%, maybe they'll hit 20%. There's the question mark that they were expecting by 2025 to hit 50 billion in revenues. Can they hit that target? So that's why the stock dramatically sold off, because people that no longer believe that narrative are cashing out now, because it's a business that's grown quite substantially over the last 2 or 3 years. Hasn't grown that much in the last year, but over the last 2 or 3 years, high quality business, and everyone is kind of like, yeah, they're going to grow and they're going to reach this 50 billion target by 2025. And now there's question marks of whether they can do so or not organically. So that has obviously meaningful implications. I think that they might, because as this balance sheet, if memory serves me, has approximately 10 billion in net cash once you extract out the debt. So it's a business that I estimate is going to make approximately 6 billion of free cash flow next year. So if you have 6 billion free cash flow and you have a net cash position and it's growing that free cash flow, you can do something interesting. You can make some kind of interesting acquisitions to kind of get their digital wallet, Venmo, kind of, to solidify that slightly. I think that they might, but anyway, so that's the thing that I want to talk about PayPal. Just briefly, I want to talk about Square, because Square is a business that I do own. I'm very passionate about this business. And yeah, everyone kind of compares and contrasts PayPal and Square. So I just wanted to say one thing, okay? So when you look at Square, remember that approximately 60% of its revenues are derived from cryptocurrencies. So I don't want to myself invest in cryptocurrencies, but I'm very content to be a shareholder in a business led by much smarter people than me that understand the business. But importantly, in the case of Square, they're not like long crypto per se. I know that they have a small percentage, like 50 million worth of crypto, but I mean, ultimately, when you, as a consumer or even a merchant, trade in crypto via the Cash App, Square has to buy that crypto on an exchange, give it to you. So they have a lot of they buy and sell at the same time, so they recognize a lot of revenue, but they also has a lot of cost to offset that. That's why when you look at Square, you should only look at its gross profits. Really, I'll just take a sip of water. So when you think about Square, I mean, I think that it's going to be quite interesting, because Square is acquired Afterpay, and Square is growing its gross profits, as you can see, substantially faster. So that the last quarter they grew at approximately, could be wrong, I think it was 43% year over year, it might have been 44% year over year. They don't give any kind of hard numbers, but what they do say is that going into the next quarter, they continue to have strong growth expected. So for intents and purposes, they're growing at approximately in the ballpark of 40%, maybe even like, let's say 36%, something like that, over the next year. Then they have Afterpay that they're going to be buying as well, that just gives a broader reach to the Cash App to do the buy now, pay later. So I kind of wanted to just talk about that very briefly. I missed the other question. Comment is saying about the volatility extreme. Yeah, so I think I've kind of talked about the volatility a little bit already. If I've not answered enough about the volatility, just drop me a question for the next time. I'll be sure to address that. How many positions do you have in the portfolio, and what's the weighted largest position? So I have, I think it's 15 stocks in the portfolio. 5 of those stocks account for 50% of the portfolio. So the 10% weighted the first 1, 2, 3, 4, 5, because I don't know which one of those is better. I don't know if Fubo is better than Upstart. I don't know if Upstart is better than Digital Turbine. So it's very difficult for me to have any kind of I can't see the future, and because I can't see the future, I just kind of equally weight the top 5 positions, and that's why my portfolio is so freaking volatile. Because if you have 5 positions making up 50% of your portfolio, and then you're comparing yourself against the S&P 500, which is 500 companies, and most of them is obviously market cap weighted. So most of those companies, I think the FANGs account for approximately, FANGs plus Tesla, I think is approximately 20%. So you got about 5 companies that make up 20% of the markup, and those are quite smooth overall. I know Tesla can be a bit wild, but you know, if you look at, let's say, Microsoft and Apple, they kind of don't move around a lot. So if you're investing in kind of slightly smaller caps than that, and you're heavily concentrated in 5 stocks, you know, the volatility is absolutely crazy. And that's one of the things I wanted to talk about. So something that I'm quite passionate about is behavioral economics, and I'll even take that away, the word economics. It's just behavioral investing. Something that the most difficult thing to an investor is how they deal with a loss. So I've said before, and I'll say again, that the professional investor understands that when you make a bet, a proportion of those are going to be failures. Okay, so let's say you're a great investor and you're 6 out of 10 times correct. You know, you're going to be fantastic. But 4 out of those 10 times, you're going to not be right. And it's how you deal with those times when you're wrong that defines you as the investor. So if you're the kind of person that says, okay, oh, I've made a bad move and I'll just wait another year to see how things go, that's one style. And there's not right or wrong. I just say how I do things. You know, if you look at, for example, I don't know, like how Carl Icahn invests is obviously very different from how Warren Buffett invests, but they're obviously both billionaires. So it's just about how you as an investor are predisposed and your temperament, really. So when I recognize that I've made a mistake, I want to walk away from that investment straight away. And it's how you deal with that. If you look at the investment, irrespective of whether it's down or up, if you look at an investment and you felt, okay, I felt when I made my 3 bullet points that I wrote to myself of why I was buying this. I always say, write 3 bullet points of why you're buying something. And one of those bullet points has to include the valuation. So if I look at what I felt, and then I say, okay, the company is not doing what I thought previously it's doing, I'm out. And it like that, and it you know, people get really frustrated with that, because like you're kind of supposed to be entrenched, and you know, and it really jars with people. But I say that's the only reason why I'm able to outperform the S&P is because when the facts change, I very quickly change my mind. And there's from the German writer that wrote Stock Market Wizards, he says that the difference between a good investor and a great investor is that when the great investor sees that they've made a mistake, they reverse their position and go short or go long, whichever way. So I don't short companies, but it's that ability to understand new information coming in and to change your mind. Yeah. So is to be able to. There's a Charlie Munger quote that says that the human brain is a lot like the human egg. Once an idea gets in, the egg gets sealed off. The human brain is a lot like an egg, and the idea being the semen. And once the semen gets into the egg, it crystallizes to new ideas coming in. So the ability to kind of get that information coming in and say, okay, I thought, and I was really, really passionate about this business, but the facts right in front of me are different. You need to get out of that position really quickly, because you're just gonna, either you come out of that position or the market is gonna take that position from you, and it's gonna, over the next 6-7 months, is gonna sell off. So you have 2 choices. You can either, as I always say, you can either sell on the way up or you can sell on the way down, but you're not gonna sell at the top. So you just have to you have to be able to just kind of take I like to look at these companies outside of trading hours, because I don't want to be influenced by how the market is reacting. I like to kind of just look through the company and just spend some time. And I always say to people, whenever you open the earnings results, go to the bottom of the press statement, start from the bottom up, because all at the top is just narrative to try and trick you. Look at the tangible numbers and see how is the business performing. So someone asked about the metaverse. So that's a really interesting question. I think it's really, I think it's interesting. If everyone's kind of seen the $1 trillion company that's changed its name to Meta, also known as Facebook, I think that's interesting. I don't think it's particularly as new as this last quarter. It's been something that's been in the works for some time. Even smaller companies, to a certain extent, are doing this. Let's say Snapchat or Snap. They don't call it like this, but Snap says, okay, I don't remember, I think it's called Lenses. They got these kind of glasses that they sell, and you could try and do some commerce by putting these lenses on and see how certain clothes would look on yourself using virtual reality. So the idea behind this is that you would see a better fit for your clothes, and you wouldn't have to buy something and then return it if you don't like it. So it's not only Facebook that's doing it. So obviously Apple's very much aggressively doing it, but a lot of companies are really positioning themselves into this. And metaverse is just the ability to be in virtual reality and interact with somebody as if it's normal life. And it's quite an interesting thing. So if you think about it, we could all be in a room virtually, and I could exchange you some insight, and you'd pay me with some kind of artifact, and that artifact would be worth something. So you could have commerce there, and anyone that's kind of been an investor for some time understands that commerce is so important for economies globally to grow. And it's interesting, but it could be something that I feel that would downstream actually lead to much more connection between people on a global stage. And I don't want to kind of digress very much, but I just wanted to say that even happening fewer wars, because if I'm trading a certain item with someone in Afghanistan, I'm like, okay, that guy's cool, he kind of paid me for something, and it would just break down a lot of the barriers, because a lot of times we kind of feel like someone is a bit different because we don't really relate to them. But I think that if you're just able to connect with someone so much closer, you kind of get close to that person, you understand them a bit better. And I think it's quite an interesting dynamic. I know that it's a very volatile period right now, and I just wanted to mention a few things right now. So one of the things I wanted to say is that it's very important when you invest to buy into companies in your portfolio. When you get the sum of money at the start of each calendar month, so let's say you get your salary, don't buy into the company that feels the best towards you. I always say to people, split your capital into 3 positions or so, and you invest into the 3 positions that you like the most. And the reason why I say that is because it strips away the narrative. If anyone's read Daniel Kahneman, Thinking Fast and Slow, you see that a lot of what I say is really about that, how our mind is triggered, and how we're primed into certain things, even if we don't think we are, even if we're trained not to be. He gives an example, he gives zillions of examples, but one of them is about if you say, what's the last 3 digits of your telephone number, and you say, for example, 496, and it says, how many African countries are in the United Nations, whatever number you start with in that 496 number, it was how many you would say, it would anchor you higher or lower depending on your telephone number, which obviously has nothing to do if you speak logically about how many African companies are in the United Nations. But we are primed, we're human beings, that we easily prime towards certain actions. And that's why I say, if you just equally weight your capital into the top 3 stocks that you like the most in your portfolio each month, irrespective of whether the market is down or up, it really strips out a lot of the emotions involved in investing, because investing is a lot about just how do you deal with emotions, and how do you navigate this volatility that we're all seeing. And it's quite interesting, because if I think back, 2021 has been particularly volatile. So in 2020 there was a kind of large drop, but then it was quite smooth after starting around May time. It was quite smooth coming back up, going up. But in 2021, it's been really, really crazy, and I don't know what to make of it. But I think that this could be the new normal. And a lot of people say that the new type of investor coming to the market that has been heavily exposed to cryptocurrencies, they're quite used to this volatility, and older investors are kind of a bit unsure about how to deal with this volatility will be at a loss, at a psychological disadvantage, and that the new investors that understand that, you know, volatility from cryptocurrencies is part of the way to compound wealth over time. I think that could be just an interesting dynamic to keep in mind. Okay, if anyone wants to kind of ask any questions, please feel free to drop me a question right now, and otherwise be sure to write to me over the coming week, because I would love to be able to give you fuller answers to questions as they go, and prepare in advance for this talk. So yeah, unless you want to kind of write me a question now, I'm so grateful for your time. Thank you so much, everyone. It's been a real pleasure. And the best thing about earnings seasons, I think that it's pretty much over. I mean, it's been really crazy. You can just, the best thing about earnings seasons when it's over. Okay, thank you so much, everyone. I really appreciate that everyone came. Be sure to write me a question next time. Thank you, guys. Thanks very much. Bye-bye.